Hello guys, and welcome to my journal for Friday the 4th of September 2020. Well, the sell-off in the equity markets that started off yesterday, Thursday, carried on into today, but by the closing bell the major indices managed to pare back some of the losses. And although all the indices closed in the red, the damage at the close was not as bad as it was at the lows of the day. The tech index, the Nasdaq, which has been leading the sell-off, fared the worst out of all the indices, and it closed down about 1.27%. And as with any other sell-off in the markets, the financial media always feel obliged to come up with a reason for the sell-off. And I can't say I blame them for doing that, because they need to justify their existence with these stories. And they always seem to find one. They find a reason to pin the sell-off on. But in reality, no one really knows for sure what really triggered the selling yesterday. And in the current market climate, I don't think the reason really matters. Or if I can put that another way, the question really is not why the market sold off. I think the question really is, why have the markets gone through the roof, and why have they kept printing new all-time highs in spite of so many negative underlying issues. Underlying issues like the economy has been contracted. Unemployment rate is at 8.4%, albeit it's come down from about 20%, but 8.4% is still pretty high. With the COVID-19 infection rates remaining stubbornly high, flatlining, or in some cases actually ticking up. With many small-sized brick-and-mortar companies folding up every day. Think about the dry cleaners. When was the last time you dry cleaned your clothes you wear to work? Think about the small retail outlets. Think about private nursery schools that haven't opened. All these companies are folding up nearly every other day. Airlines are laying off tens of thousands of staff. And on top of that, there are many small and medium-sized companies, particularly in the energy sector, that have been borrowing heavily in the high-yield market, the junk bond market. And they're borrowing not to invest for the future, they're borrowing to stay afloat, they're borrowing to pay bills, to pay wages. And many of them probably wouldn't make it through. And layer on top of that the near future uncertainty in relation to the presidential elections and the tensions in the trade relationships between US and China vis-a-vis Huawei, TikTok, and a few other tech companies. Well, given all these factors, the financial media digested all these factors, and it came up with a reason for the sell-off, a catalyst if you like. And the reason they came up with is that SoftBank, some of you might know SoftBank as a venture capitalist that backed WeWork, the tech company. They said SoftBank had been heavily buying options on Nasdaq stocks. And apparently they bought about $4 billion worth of options on some underliers they already owned positions in. Underliers like Amazon, Microsoft, Facebook, etc. And according to the FT, the Financial Times, SoftBank bought billions of dollars in individual stock options in big tech companies over the past month, driving up volumes and contributing to a trading frenzy. SoftBank declined to comment. So, the financial media has attributed the sell-off to SoftBank's option buying frenzy, which presumably stopped abruptly and triggered the selling. And in all honesty, SoftBank's activities in the options markets probably did contribute to the sell-off. But the question is, does it deserve the center stage the financial media is giving it in terms of headlines? And in spite of all the negative factors I mentioned earlier, the market continued to charge higher, and you ask yourself why. Are the markets going up based on fundamentals, or are the markets going up based on stimulus from the Fed? And if one belongs to the former camp and you believe that the markets are driven by fundamentals, then you most likely would see the markets as overvalued, or at the very least least stretched. You look at a company like Tesla, which has been leading the charge. Tesla has gone through the roof. And if you look under the hood and look at some of the fundamentals, and even with the tiny sell-off in Tesla this week, Tesla is trading at a PE ratio of 288 times. The price to earnings ratio 288. And to put that in some perspective, the auto industry has an average of 17 to Tesla's 288. And if you make the case that Tesla is not a car company, it's a tech company, well, let's have a look at the PE of a tech company. Facebook is a tech company. Facebook is trading at a PE of 34 times earnings. And while the tech sector as a whole is trading at a PE of 41. Remember, Tesla's is 288 times. The S&P 500, the broad index, is also trading at a PE of 41. So by nearly any PE measure, which is just one fundamental, Tesla is somewhat pricey or expensive. On the other hand, if you believe that the Fed put is here to stay and the stimulus will keep pumping liquidity into the markets, then the fundamentals do not matter one iota. And it does not matter because the liquidity from the Fed is not going to be parked in US Treasuries, where it would yield less than 1% over a 10-year period. Instead, all that liquidity is going to go into equities and into companies like Tesla, where it could earn 10% in a month. And a few other factors that probably contributed to the sell-off. Many fund managers dislike concentration risk. Concentration risk in terms of one position or a few positions posing a major risk to the entire portfolio. They like to weight things evenly, if I can explain it like that. And as such, many fund managers have risk policies in place that trigger a sell whenever any one position becomes significantly large in a portfolio. Well, last week a few funds disclosed that they have been trimming their positions in the likes of Tesla and other tech stocks because they have appreciated so much that they now pose a significant threat, or they've now become significantly large in their portfolios. So that's not one of the other reasons why, one of the other drivers, if you like. I believe there's so many drivers that led to the sell-off, not just one headline that you can pin it on. And I don't know if you heard last week, Elon Musk. I mean, I like the guy, and I can't blame him for taking advantage of the market. So Elon Musk came out when Tesla hit another all-time high and said, I'd like to take advantage of the high price of my stock, and I'm going to issue $5 billion worth of stock, $5 billion more, at the current market price, not even at a discount. And surely that dilution would encourage you to rush out to buy more stocks of Tesla, right? So there you go. That could be another driver why these stocks sold off. And finally, before I move on to something else, we can't disregard the retail investor. The retail investors have undoubtedly been part of this force driving up the markets. The Robin Hood crew, if you like. This group of investors came into their own during the lockdown. During the lockdown, they spent more time at home, or all time at home, on their laptops, on their PCs, trading stocks via Robin Hood. Well, the rumor has it that with the sports beginning to open back up and the betting on sports resuming, many of these retail investors, a new breed of retail investors, if you like, many of them are rotating out of trading stocks and moving back into sports betting. So that could account for, again, some of the money coming out of the markets going into sports betting. The point I'm driving at is there is no one reason. The markets always go up and down in cycles, and if you think about it, if you bought Tesla even if you bought it 6 months ago and Tesla hit an all-time high, and you look down or you look at the headlines and you see all the negative news, COVID-19 cases going up, economy shrinking, unemployment going up, you might be, maybe you might need some cash and you decide to sell your Tesla. I mean, what's wrong with people taking profits? Maybe a lot of people took profit, and that's another reason why the market went down. But I don't buy the headline. I never really buy these financial media headlines, but I can understand why they need to sell a story. Moving swiftly on to the VIX. So the VIX is back above 30. Whether it stays there or not, I have no idea. But the VIX today closed at 30.75. It was much higher intraday. It was as high as 32. And what would be interesting is to see if the VIX consolidates above 30 and stays above 30, or if it dips back below 30. But regardless of if it stays above or below, the VIX at this level is pretty good for option selling strategies. And I should be able to find a few trade ideas for the October contracts. That said, there are now 13 days until the September contract expires and 41 days until the October contract expires. Talking about trade ideas, I had 2 new trade ideas today. The 2 trade ideas were in SE and PDD, but I didn't get a fill in those trade ideas. I still like both of them, and I'll see if I can put them back on next week and reload them. Or for more details about the 2 trade ideas, you can go to the Trade Ideas Alert Forum, or you can click on the link underneath. And that takes me to my open positions. I now have 4 open positions, 3 in the September contract and 1 in the October contract. So starting with FSLY. So FSLY, I sold the 80.75 put spread. And at the end of week 4, which is this week, I have a negative P&L of $40 per contract. So FSLY closed at 80.92 today. FSLY closed at $80.92. So as at last week, my P&L on this thing was, I think it was positive $60 per contract. It has turned negative this week because as the market sold off, FSLY, which is a tech company, also sold off with the rest of the markets. But that said, my short strike is still at the money. It's not out of the money, but it's just at the money. And the market appears to be consolidating around the 80 mark. So, and with about 2 weeks until the September contract expires, I'm going to leave this one to gradually decay as the price hangs around the 80 level. The second position is in CRBP. CRBP, on this one I sold a 2.5 put spread. CRBP. On this one, my short strike has never been tested. Since I sold it, the market hasn't even gone to 6 or 7, let alone going anywhere near my short strike. CRBP, not BM. BP. Can't type CRBP. Right, CRBP is at $9.25. My short 5 put has not been tested and it remains out of the money. My P&L was positive 60 last week, and for some weird reason it's gone to positive 52 CRBP. This position remains a mystery to me. I am not sure why the market makers have failed to mark down the 5 puts aggressively, given where the market is. I mean, I'm short the 5 put. This thing is at $9.25, nearly 100% above my short strike. There are 2 weeks left. I know anything can happen in the market, but a 5 put with the market at 9.25 and no pending news that I could find. I've been looking for news, pending news on this thing for about 2 weeks. I couldn't find anything. So my plan for this one is my profit target, if I go to my activity tab on CRBP, my profit target is 50. They're still marking this thing at 87. With 2 weeks ago, if at the end of next week my profit target of 50 cents is not hit, I am going to cut it down to 10 cents and take it into the expiry, because I've stayed in this thing for so long and I might as well get full price. If I'm taking this thing into expiry week, I'm not looking to buy back at 50 anymore. I'm looking to buy back at 10 cents. The only thing I can change that calculus is if this thing drops 40%, if you like, to my short strike. But that's the plan on that one. My next position is in SLV closed, taking profit on that one. ARKK sold a 1995 core spread. ARKK. So ARKK closed at 87, and there was a bailout for me on this position this week. As at the end of last week, I had a negative P&L on this position, but now my short strike of 90 is just out of the money. I mean, this thing is very, very volatile. You can see the IV is a 72, so the daily range in this thing has gone through the roof since the Nasdaq sold off. So my 90 short call is currently out of the money. It was in the money for most of last week, and because it's now going out of the money, my negative P&L of 115 from last week has shrunk down to negative 17. So that's a swing of nearly $100 in my favor per contract. I'm still holding on to this position as there is still more theta decay to happen over the next 2 weeks, and closing it now simply makes no sense at all with so much time value in it. I know my maximum risk and maximum loss defined in this trade, and I'm happy taking that risk in order to make a profit on this position. So that's the action plan for this one. Sit in my hands and do nothing. And my final position is, it's in the October contract. Alibaba. So Alibaba, it's not the end of week 1 yet in this one because I only opened it on Thursday. So I'm not going to do a full analysis, but I sold a 260-255 put spread for $1.75. Let's see where Alibaba is. Alibaba is at 281, so my 260 short put is out of the money by about $20. Next week would be the end of week 1, and then I'll start looking at this one as well. It's been a long recording, so I think I'll skip the watch list today. I'll do a watch list on Wednesday. But a quick recap before I go. I believe the markets are closed on Monday due to Labor Day, so there's not going to be any journal on Monday. And I'll be looking to reload the trade idea in the SE and PDD on Tuesday, unless the markets change significantly on Tuesday. I'll also be looking for more trade ideas to put on next week, and hopefully hoping to find an additional two or three. But in order for that to happen, I need to close out some of these. I need to free some buying power, so I need to close out some of these FSLY, ARC, CRBP. But we'll see what happens. So the plan next week, put on about 3 trade ideas or 2. So for those in the US, I wish you a happy Labor Day in advance, and to everyone else, have a lovely weekend, and I shall see you on Wednesday. Goodbye.